about becoming your own bank. This will be part one of a two-part series. I believe it's going to be two parts. It's extensive. And so the first thing we have to go through today is the history of banking, because we have to understand the history of banking. As you've noticed on every workshop, I've been going through the history and then what it is, or what our actual subject is about. So we need to go through first the history of banking. We'll also in this series be talking about the average rate of return versus the true rate of return, and uninterrupted compound growth. So we're going to be looking at the ebbs and flows of the banking history, how that moves, and then you will understand why we want uninterrupted compound interest, and literally what that means and what it will mean to you. Okay, so before we get started, I want to invite some people, get some people on here. So give me a second to be able to do that real quick. That way I want to be able to make sure that we tag and text and get as many people as possible on this live right now. Okay, so if you're on, please share it with your people, share this with everyone, show the love, and share. That's what we want to do. I see already that someone has shared this already. I appreciate that. I'm going to share it now as well. So let me invite, rather. I'm going to be inviting. That's what I want to do. I gotta remember how to do it again. I gotta hit
I
this.
see already that someone
All
has
right,
shared
let me
this
mute my
already. I
computer
appreciate that.
so
I'm
y'all
going.
don't get double back real quick. And then I'm going to share. Okay, I'm doing the share. Let me invite. Right, I want to get as many people on as possible. Come on, why are you dropping below? I hate when this thing does this. Invite. They need to make this much easier, is what they need to do. It's not what I'm looking for. Invite, invite. No. All right, so that should do that. Let me see. You know what? Because I'm not on my phone. I'm on my computer. I can't do it on the computer. I have to do it on the phone. And so that's all right. So we're gonna go ahead and keep it moving. I don't want to hold you up. So we got this workshop today. Part two is going to be on Sunday. Part two, like I said, will be on Sunday. I want to thank everybody coming on YouTube, LinkedIn, uh, uh, Twitter, TikTok, Instagram, and Twitch. I appreciate all of you all that are on here. If I missed any of you all, I do apologize. But I'm on so many stations right now, and then we're also on Spotify as well. So you can find us on Spotify as well. Okay, so again, this workshop, Become Your Own Bank, we've got the workshop part two will be on Sunday, probably around the same time at 1 o'clock. I'll let you all know. If you're on, you'll be able to see it posted either on Facebook or any of the links that you're on, or any of the social media platforms that you use. You'll be able to see it. And then I've also been blessed to be invited to the Lions Den, right? This is going to be a live event on YouTube at the Lions Den channel on YouTube. And I'll be going over understanding money, but this will be like an interview type deal. So you guys are all welcome to come see me there as well. And then we've got the Financial Literacy Month. Also, part four will take place on Monday, or excuse me, Tuesday. Okay. So we got some big things coming up. I want everybody to understand and be a part of those things as well. And again, we're going to get started in 1 second, moving towards making sure that we are. Hold on. I want to be out of this. I want to be in this one. Boom. This one, I think. Yeah. I don't want to be live with it. I want to share with it. So give me 1 second, guys, and we are going to get started. I think I got it on my phone where I can invite people. Yes. Let me invite people right now. Um, and then we will get started, okay? There we go. Now we've got some more options to send. Good. Straight down the line. Yeah, and this lets me send to a lot of more people this way. Let people know I'm online. Let them all get in if that's what they want to do. And we're going to go over the history of banking. And we're dealing with, again, the piece on we're going to be dealing with the becoming your own bank. And this is extremely powerful. Okay, so let's go ahead and get started. Let's really get into this and let's move forward. So with that, we're going to go into the history of banking, right? And so the history of banking. Okay, so we're going to start at the 1700s. Right, we're going to be dealing with American history on banking, because you need to understand the American history on banking in order for you to be able to really grasp the concept of this process. Okay, so let's look at it, let's read through it, and let's really look at the ebbs and flows and what's going on and understand banking. This is going to take us from the 1700s to the 2000s, and then I'm going to move into the 2000s up to where we are basically today. Really, it's going to stop at around 2018, right? So, and we know that there's another crash about to take place. It's going to be a big crash that's going to take place. I might talk about that in part 2. I know I'm going to be dealing with the different forms of banking in part 2, and I'm going to be dealing specifically with what we talked about, the difference between the different types of interest coming in, true returns versus average returns, and then also how we're the other thing dealing with uninterrupted compound interest. And very important word is uninterrupted compound interest. And this is how we win. And this brings us back to the page on accounts that we dealt with Google when we were talking about accounts. Accounts is so important. All right. So this is very, very, very important as well. Okay, so here we go. So the mid 1700s, the colonies have no banking system and no common currency. European banks and governments are meeting capital needs, while foreign coins and some colonial paper is in circulation. Bartering is a common means of payment. So at this time, bartering is a common means of payment. The European banks and governments are what? Meeting the capital needs. And the colonies themselves at this time have no banking system whatsoever and no common currency. So trade is big, and then the European monies are big. Okay. So this is very important to understand here. Okay. Very important to understand. Now, 1782, the Bank of North America, established by the Continental Congress, becomes the first charter bank in the United States, right? So the Bank of North America, right, established by the Continental Congress, becomes the first charter bank in the U.S. This is 82. In 1784, the state of New York charters the Bank of New York. 1791, the U.S. charters the first bank of the United States, the government's first attempt at a central bank, right? This is the first bank. This is like a Fed bank. This isn't a colonial bank or a state bank. This is like a Fed bank. The government's first attempt at a central bank. The bank has over 20-year charter, which is not renewed. In 1811, the bank is bankrolled by New York merchants and chartered by the state of New York. Today, the bank is known as Citibank. So this Citibank was established in 1791, right? 1799, a group of New York investors established the Bank of Manhattan to fund construction of a water supply for New York City. The state of New York charters the bank. So if we notice here that this bank's reason for establishment is to fund construction of a water supply for New York City. I want you to start recognizing what bank's sole purpose is, because you're going to understand that they're taking your money and investing it in what they want to do. All right. And we're going to talk about that in part 2. But I really want you to start understanding purpose for banks as we go through this history. Why banks are established, what they do, what is their true purpose, right? Because you just think it's somewhere for you to put your money. But every bank, all banks have a reason for being established, right? Or have a reason for being established. So the early 1800s, the Industrial Revolution produces a new class of merchants and manufacturers. The need for capital increases between 1815 to 1819. The U.S. economy booms and more banks exist. As a developing country, the U.S. has a reputation for not repaying loans. Notice, as a developing country, right, the U.S. has a reputation for not repaying loans. And I want you to understand that a country is no different than a business. A country is nothing but a big business. That's why it's incorporated, right? So you want to understand that a country is big business. So therefore, it's not known for paying its loans even today, really. But in its beginning, because it takes years to be able to successfully establish a business with profit. However, they remain in debt and they use debt to their benefit, right? So when we get into Rich Dad Poor Dad a little deeper, you're going to see the difference between good debt and bad debt. But you have to understand debt and how to use it properly. But the banks master debt. The country rather masters debt. The banks do too, actually. And the U.S. has a reputation for not repaying loans, and many European banks refuse to lend to the U.S. government. 1809, the Farmers Exchange Bank in Gloucester, Rhode Island, fails. Fails. The first U.S. bank failure. So the Farmers Exchange Bank is the first U.S. bank failure. 1816, right? And you'll hear me a lot of times, many of you all that know me from the business side, there's a statement that is said and that I like to repeat and that many people understand, and that's called, you must fail your way to the top. So failing your way to the top is key, even no matter what you're developing, right? So 1816, the Second Bank of the United States, which is the U.S. government's second attempt at a central bank, is established. Its 20-year charter is not renewed, and the U.S. does not have another central bank until 1913. I told you this year is very important. You're going to see this year across the board. We saw this year in taxes. We saw this year in currency, and now we're seeing this year in banking. This is a very important year, 1913, as well as 1929 1929, 1930, right? So we want to really get a grasp on this, right? Because this was a bit major change that took place. And you're about to see another major change take place now with crypto and with the currencies being devalued, as well as gold-backed currency possibly coming back into being. You're going to see a major shift right now. Now is a time to really understand money, banking, taxes, and your finances, and making sure you get a private bank that is not, or create your own bank that is not attached to that system that is going to be devalued and fall. And that is what we're talking about. But before you can do that, you must understand money. You must understand banking. You must understand taxes. You have to get this in your mind, right? So that you have the knowledge base to be able to move forward and work through this process, okay? So 1819, more than 420 banks exist in the US, all of them printing banknotes and making loans, right? So every bank printed its own money, right, and made loans. The Panic of 1819, the Second Bank of the United States calls its loans. A panic sweeps the US and many banks fail. Why do many banks fall or fail at this time? Because they're asking for their loans. See, remember, they're operating off of debt, right? So they're operating off of debt. And now they called the loan. So they don't have the money to repay the loan. So they're going to fall. Now in 1820, approximately 300 banks operate in the US, right? They went from 420 to what? 300 banks. Now in 1829, New York is the first state to adopt an insurance plan for bank obligations. Between 1829 and 1866, 5 other states adopt similar plans. Okay. Now 1831, Comley Rich House, Philadelphia, for first U.S. home financed by a savings and loan association. So here's our first savings and loan association. Rich, a maker of combs, received a loan in 1831 from the Oxford Provident Building Association, the nation's first savings institution. Okay. Now, 1837, with the demise of the Second Bank of the United States in 1837, only state chartered banks exist, right? Only state chartered banks exist. During this period, known as the free banking era, state chartered standards often are not very stringent, and many new banks are formed. Large numbers of them will fail. The era ends with the passage of National Currency Act in 1863, right? So that era was from 1837 to 1863. What's the key thing that we got out of this? Now there are only state banks, right? Because the second bank failed. That was a federal bank or a national bank, as they'll call it, a national. But it was really a federal bank, right? Now, here's what I want you to get. That this was like the gold rush, right? This was like the California gold rush, even though it hadn't happened yet. But this was like the California gold rush for banking. See, when you see opportunity like these, I'm going to show you a key phrase when you know there's an opportunity available, right? This is $1 billion game right here that you're about to get, that I'm about to share with you right now. When you see these words, during this period known as the free banking area, watch this. State charter standards are not very stringent, right? When you see that, that means that it's unregulated. When you see the word, this industry is unregulated, that means there's massive opportunity there for you to get as much done as possible until they come in and regulate it. For example, right? Let's look at the internet. When the internet came out, it was totally unregulated, right? You could go on there, you could do everything. You didn't even have to pay tax. When the internet first came out and when I had my first website, I was selling products and services and had to pay no tax. If you sold something on the internet, you didn't have to pay tax at all, period. Then you started seeing regulations come into the internet. So if you're in a position to be able to take full advantage of opportunity, right, when it shows up, when you can hear these keywords, deregulated, this industry is not regulated as of yet. When you hear those words, that means that is the gold rush industry or the gold rush environment of that time. Or if you hear this, most people have never heard of this, or the market, only 1% of the market share has been tapped into. When you hear those type of words, those are the industries you want to run to, right? Because it's not saturated. When you hear the market is saturated, that's when you want to start considering. That's when you need to start doing the numbers. You really need to look at that. And I'm not saying jump into any industry blindly, but when they're talking about a new market that's coming out and it's not saturated, and there's only 1 to 3% of the market share has been tapped into, really is usually about 1%, and that is not regulated yet, it's deregulated. Let me tell you something. Or unregulated or deregulated. If they become deregulated, that means it's wide open. because the market's been proven it's been regulated, but now they deregulated it. But if it hasn't been regulated yet, that means you got about a 3 to 5 year run, maybe 10 even, where it's going to be unregulated, where you can do whatever you want to do in that industry and make as much money as you can before they regulate it. Now you'll be in position when they bring in the regulations to be able to pay the individuals to make sure that your company is following regulations properly. Right? It's the same thing with stocks, all of that. It's the same idea, but you need to be able to hear those keywords. And when you hear those keywords, you know, hey, I want to invest in this. I want to be a part of this industry, right? These are keywords, but I want you to see that. So banking was right here at this juncture, banking was the industry to jump into, right? Banking was the industry. So massive banks, but some are going to survive, some ain't. That's just business. That's just business, period, right? And so from 1837 to 1863, this was the free banking era, no regulations. That was what, 30 years, almost 20 some odd years to ramp up all the money you could until they brought in the regulations, right? The mid 1830s witnessed an economic boom characterized by inflation and speculation in public land sales and road and canal projects, right? So this was an economic boom. The speculation is fueled in part by the following three policies: the removal of federal funds from the Bank of the United States and from other banks, a distribution of federal surplus from these banks to state banks, a requirement that specie, gold or silver coin, be used to buy public lands, right? Which leads to failing land sales and specie shortages, right? So now these had to be used to buy public lands. This changed, right? Now, the pressure on many banks increases and a lack of confidence in the state bank abounds. That's because there's no regulation, right? So the government wants to bring in regulation. Why? Because private companies can now make money off of regulating, and the government does too. It can tax you on it as well, right? So they're going to make sure that two things can happen. Whenever a new industry comes out, the first thing it's going to do is come out deregulated with no tax. Let's look at Airbnb as an example. Airbnb, when it first came out, there was no tax on it. It was deregulated. You could go in there and you could start your Airbnb, and you didn't have to pay taxes really. You pay regular tax, like sales tax on it. But then over time, what did they introduce? They said, no. Airbnb is now a service like a hotel, right? They put them in that industry, the hotel industry, right? So now they pay hotel tax on top of the regular tax. So the government came in and said, no, we can get more money out of you. That's what happens, right? But if you would have got in them first 10 years of Airbnb, you would have been able to stack up on another level at that time. This is what I mean. It's the same thing that's happening. And so now they're saying, so what's coming in here is because they got people's money, what they're going to do is instill fear. They utilize news to be able to do what? Instill fear. So now they can come back and say, boom. That's why it's called a panic. How is panic induced? It can't be induced. One person is just afraid and everybody falls. No, the masses have to have that feeling. That's what creates a panic. The masses. So there was information introduced to the masses in order to get them to panic, right? So that now they could bring in regulation, right? The resulting bank panic in 1837 caused many banks to fail over several years. This panic is followed by a sharp depression tied to general downturn in the business cycle that lasts until 1841. So now we got, 4 years in between that approximately? Yeah, 4 years, right? So now you're seeing this happen, but remember, there's still the free banking era until 1863, right? But this is the beginning of the induction of the panic, so that the government can come in and regulate it. It's very important to get that. It's the same thing that happened on the internet, right? They started what were they saying? They said, if we don't regulate the internet, we got a bunch of other countries coming in and being able to go in the back behind and do this and do that and da. All that took place, right? If you remember the news, go look up the news articles. That was inducing the panic. But then what comes with that is once the people are scared and agree to the terms, then they change the terms of the agreement. And this happens every time. So now internet is taxed. That wasn't in the initial regulation. That came later. But they had to first get you to agree that there should be regulations. Once they get the masses to agree that there should be regulations, then comes regulation. Then they can do whatever. And that's the key, right? The panic is followed by a sharp depression tied to a general downturn in the business cycle that lasts until 1841. 1843, the first issue of Banknote Reporter is published. This weekly report on the value and validity of the banknotes was the most respected of many such publications that merchants relied upon to evaluate the reliability of currency, right? So this weekly report on the value and validity of the banknotes was the most respected of many such publications that merchants relied upon to evaluate the reliability of currency, right? So now they can pick and choose which currency is the best, right? It's very important to get, because remember, there's not one currency at this time. All banks are still printing their own currencies. I want you to get that. 1849, the gold rush begins. Now everybody's rushing for gold. Why? Because the specie, right? A requirement that specie gold or silver coin be used to buy public. I'm here. So I jump back up just so you guys know. A requirement that what specie gold or silver coin be used to buy public lands, right? So now gold is in call right now. Gold is important at this junction. Gold is important right now. Now we go to the next, right? So now, the mid 1800s, European banks financed 30,000 miles of railway tracks in the U.S. So European banks financed this, right? Not the United States banks. 30,000 miles of railway tracks in the U.S. A new phase in high finance with the potential for large returns. Railroads become the driving force of the economy. Now, if you go back to Understanding Money, the one I did on Tuesday, and if you go back to taxes, if you go through the timelines, you're going to see how all of this ties in together, right? The railroads open up the West and provide demand for new steel industry, which makes new commerce and new industries possible. New cities emerge along the railways, and commerce organizations around these cities. Speculators seek capital for their new ventures. By 1914, there are 253,000 miles of railroad in the United States, right? Now remember, 1913 is a very important year, right? But by 1914, there are 253,000 miles of railroad in the U.S. Prior to the Civil War, the U.S. has a loose system of finance and banking. As the nation grows, it demands a more mature financial system. The National Banking Acts of 1863, right? Banking Acts. What is this called? Regulation. This is regulation. I want you to be clear. This is regulation. So the National Banking Acts of 1863, 1864, and 1865 are a significant movement in that direction. With the demise of the Second Bank of the United States in 1837, only state charter banks exist, right? So this is what? The free banking era until 63. During this period, known as the free banking era, state charter standards are often not very stringent, again, deregulated or unregulated. And many new banks are formed. Large numbers of them will fail, as in any business or any industry that happens. The era ends with the passage of the National Currency Act in 1863, because now all these banks are being what? Regulated. But right before they regulate, 1857, what do they induce? Panic. I want you to notice the up, down, the ebbs and flows. I want you to notice them. This is extremely important to get. It's extremely important to notice the ebbs and flows of these up and downs, right? These ups and downs. So the panic of 1857. The economy is weak because of overbuilding of railroads and overextension by banks to finance construction. Several hundred banks fail. Most banks suspend specie payments such as gold coins. Unemployment increases, right? So what does this mean? That means, remember, all the money's supposed to be backed by gold at this time, right? But they won't do specie payments now. If you brought your money in to switch it over to gold because they didn't have it, right? Unemployment increases, right? I want you to get this. Oil is discovered in Titusville, Pennsylvania, 1860. There are 1562 state banks. 1862, there's 7,000 different banknotes are in circulation. 5,500 fraudulent banknotes are in circulation, right? Now, 1863, this is at the same time the what? National Currency Act comes in. Next year, the National Banking Act comes in. And then they update a National Banking Act of 1865. So this is like an amendment or a change to it. Once they get the people to agree, they make changes. I want you to get this. This is important. Right? So 1863, the Civil War destroys the South's economy. The North's economy flourishes. Step one, right? President Abraham Lincoln composes the final Emancipation Proclamation on 1/1/1863, right? So now the North gang beats the South gang, right? They needed to do that because the North gang's money was Confederate money. They're trying to become one currency under what? Union money, which is what we use basically today, right? So now what we're seeing is the Union needed the South economy. So Lincoln, right, beat the South, right? And then the final Emancipation Proclamation on the 1st, 1863 took place. Now, National Currency Act of 18, and I want to say this while I'm on here. So what happened also here was it moved from forced slavery, which our people were in, right? For those that don't know, quote unquote African Americans were in, right? It went from forced slavery into what was called wage slavery, which is what we live in today as wage slavery, right? So now, then comes the National Currency Act of 1863, became known as the National Banking Act in 1864. So they took it from the Currency Act to the Banking Act to the Banking Act of 1865, right? Because they're amending regulation. They get the people to agree and then amend and amend and amend and amend and amend, actually. Establish a national currency, the dollar. Now, instead of all the banks being able to print their own currency, now the union said you're going to use the dollar, which made what? All other currencies defunct. But the main currency they were trying to make defunct was the Confederate dollar, right? Then establishes national banks, which creates the dual banking system with national and state charter banks, the only such system in the world, right? So there's national banks at this time and state banks, okay? National Banking Act of 1864. This act establishes the office of the Comptroller of the Currency, OCC, initiates a system of bank examinations, right? National Banking Act of 1865. This act, intent on getting rid of banknotes, levies a tax on state currency. The tax goes from 2% to 10%, resulting in the use of checks, right? So I want everybody clear on that. This act, intent on getting rid of banknotes, levies a tax on state currency. The tax goes from 2% to 10%, resulting in the use of checks, right? So what is it that's added to it? They levy a tax. Remember I said that. What is the purpose of regulation? I didn't even know I was going to say that, but I'm saying every time it's to add tax to do what? Bring more money into the government. So they must induce a what? Panic to get the people to agree with it. So they vote to do it, right? So they're not just strong arming the people, right? They put that idea in their minds, which makes them run out and vote for the regulation, and then they can tax, which is going to increase the prices to the average consumer. It hurts the business, but the business is going to pass that along to the consumer. So every time you vote for regulation, many times you're voting to hurt yourself, right? Many times. The true purpose of regulation is not bad, but the purpose they do regulation, they don't care if something happens to you like that. They care that they can do this tax levy. And notice where they brought in the tax levy. Did they bring it in on the National Tax Acts Part 1? No. On the current? No. Did they bring it in on Part 2? No, they didn't. They waited till everybody forgot about it and then amended it under the National Banking Act of 1865 and then passed the levy. Just like I talked about with the internet, they did the same thing, right? And the same Airbnb, they did the same way, right? So you're going to see this in business on every level, whether we're talking about banking, whether we're talking about governments, whether we're talking, no matter what. That's why you had the Revolutionary War, because England was what? Taxing America. And America said, nah, we don't want to be taxed by you because we don't have representation over there for you. So they said, forget that. We're not going to be taxed by you. Right? And that created war, because that's how England makes their money around the world, on the countries that they own. That's how the United States makes money on the countries that they own. Right? It's always follow the money. 1865, there are 349 state banks. There are 1,294 national banks. Excuse me. 1869, the Golden Spike connects the Central Pacific and Union Pacific Railroads, commemorating the completion of the first transcontinental railroad in the world. 1870s, entrepreneurs begin to turn to local banks and wealthy individuals for venture capital through New York City banks, right? So now entrepreneurs are starting to get strong and borrow from the banks, right? Through wealthy individuals. Here comes the key name right here. We're going to be dealing with him. When we get to trust, we're going to really talk about him. Protect your family. When I do that presentation, we're going to be talking about him a lot in the beginning. John D. Rockefeller, right? The man that created the educational system, right? John D. Rockefeller, William Rockefeller, and partners create Standard Oil, the largest oil refining business in the world. Standard Oil is the first great American trust. The founding partners borrow much of their capital from the large New York bankers. ExxonMobil is the largest of Standard Oil's descendants. All right? Exactly. Boom. 1877, Chase National Bank is chartered. Here's your beginning of Chase. So we saw Citibank was first, right? Now we're seeing Chase in 1867. Excuse me, in 1877. 1885, there are 1,015 state banks and 2,689 national banks, right? 1886, starting in 1886 and continuing until 1933, Congress considers 150 proposals to create deposit insurance plans. Remember that. Deposit insurance plans. That was in 1886, right? 1886, correct. The late 1800s, Standard Oil becomes financially self-sufficient. It has more cash than any corporation in history and no longer needs Wall Street. This is a key point. It has more cash than any corporation in history and no longer needs Wall Street. The Standard Oil Trust, I want you to get key word there. Standard Oil and Standard Oil Trust are two different entities. I want you to be clear on that. I want you to start making distinctions as we go through this. So when we get to protect your family, you're going to get a good understanding that Standard Oil and Standard Oil Trust are separate entities. Has become a huge bank. What? The trust is a bank? Wow. Isn't that powerful? The Standard Oil Trust has become a huge bank within an industry. It finances itself against competition and provides venture capital to other entrepreneurs on high-class collateral. The Standard Oil Trust Bank becomes a natural, spontaneous offshoot of successful commerce, right? U.S. railroads desperately need capital, and British investors respond, lending massive amounts of money. President William McKinley launches the trust-busting era, right? So this is the bust up the trust. Why? Because that money they got, they don't need Wall Street anymore, right? President William McKinley launches the trust-busting era. He appoints several senators to the U.S. Industrial Commission. The commission's report lays the groundwork for President Theodore Roosevelt's later attacks on the trust's industrial titans. Pay close attention, right? Pay close attention. Remember we was talking about taxes, right? It showed how Capone and the government went to war. You're seeing this again, but on the industrial level, not the gangster level, but the industrial level. It's the same game. You got it? I want y'all to pay close. You got to pay close attention to what's going on. Industry generates surplus capital, right? Industry generates surplus capital. Remember this word surplus, because you're going to need it in your vocabulary over and over and over again. Remember when we went through the income statement, right? When we went through the income, assets, interest, all that, when we did that in Understanding Money Part 1, which was a very important process that we went over, right? What we definitely want to understand is that New York, so that surplus is key. Surplus is a word you want to have in your vocabulary regularly. Surplus, invest versus spend, right? You want to use the word invest versus spend. Anytime your money is coming out of your pocket, you want to think of the word invest. So when I'm buying this, how is this going to bring me money back? You want to think like that. Start thinking like that. If I buy these gym shoes, how are they going to make me money? Oh, they're not. Why am I buying them? If I buy this, how is this going to make me money? Why am I buying this then? You should always be investing. You should never be buying. You should be investing. Always, at all times. And you need to teach your children that. So our next generations will never be, they won't be buying, right? They won't be able to be used. They'll be now having interest come to them versus interest being taken from them, right? Which is extremely important. So now they'll become the lenders versus the borrowers. And that's where we want our children, right? We want this next generation definitely being at that stage of development. And right now, what I'm loving about this generation is the way that you all are able to understand and comprehend entrepreneurship and making money. But don't make the mistakes that we made. And the mistake that we made was we spent our money. You all need to invest your money and put them in those high interest bearing accounts. And that's what I'm talking about. So definitely make sure you get with us and do that. I'm going to do station identification now. All right. So again, we have coming up, I will be live on Sunday, right, on the Lions Den. I was invited. I was blessed to be invited to this. I love this flyer that they made for me. I appreciate it. But the I've been invited to this to speak. All of you all on my pages, y'all are all invited and welcome to attend. Please attend. Please come and support. We greatly appreciate the support. I'll be dealing with understanding money on their live channel. And I'm so grateful and thankful that they thought of me to do that. So thank you so much, my brothers from the Lion Den, my people at the Lion Den, brothers and sisters. I appreciate you all, and I'm looking forward to being there and sharing this with you. Okay. So right now we're on the financial literacy workshop 3. We already went over workshop 1, which was understanding money, right? We dealt with that already. We went to workshop 2, legally avoiding taxes, and now we're on workshop 3. All of these you can watch the replays again. It's easier to watch it on YouTube. So if you click the link in one of my lives where I'm talking, like my Rich Dad Poor Dad lives, you'll see all these links, and one of them will lead to my YouTube as well, where you can watch them, or you can watch them on Facebook. If you click on my picture and go to my feed, they'll be on there as well. You can do it on LinkedIn as well as Twitch. Twitch. All right. So just wanted to let you all know that I'm coming back now, and we're going to continue where we left off before. Okay. So where we left off was with the banks, right? The history of banking, right? And so industry generates surplus capital, right? The banking industry, and I believe it's talking about, or it could be talking about industry, period. Yeah, industry generates surplus capital. New York banks emerge from foreign dependence on capital. So now the banks are emerging from foreign dependence on capital, right? New York City emerges as an international banking center. So now it went from national to what? International. Financial panics and bank runs are common, right? So financial panics and bank runs are common. The U.S. economy does not have stabilizers to provide liquidity, such as a central bank and deposit insurance, right? So now they're looking at financial panics, right? Here we go. Again, they want to implement something, right? There are 2,250 state banks and 3,484 national banks. 1892, there are 3,733 state banks, 3,759 national banks, right? 1895, deposits for First National City Bank, which is Citibank, reached 31 million, 158% increase from 12 million in 1893. So in 2 years, it increases 158%, right? Now, this economy or this industry is booming. Remember, I told you in 1837 was the time to get into banking. Now you're starting to see the peak of banking, right? From this time right here, really. Really, when you get about right when you're talking about Standard Oil becomes financially self-sufficient. It has more cash than any corporation in history and no longer needs Wall Street. Right there, this is like 1886, around this time, right? So you're looking at now it peaked 50 years. It was not even 50 years, it was 40 something years. It peaked. But all this time was building time until 1863. At 1863, only the strongest bank survived. Now it was cash flow time. Why? Because the competition was gone. There wasn't as much competition. Why? Because the banks that didn't jump in on time, or Johnny come latelys, or the ones who didn't manage their funds correctly or understand how to run a business properly, those banks fail. So now only those survivors made it. Let me give you a case example with the internet. When the internet came out, there were massive companies. Many of them had loans from banks, but the only companies that really survived the dot-com crash, which we're going to talk about when we get to those years, 2000, the only companies that survived the dot-com crash, right, really that you hear about today is Yahoo, Amazon, Bing, and I don't even know if Google was around. I think might have just came out during the dot-com crash, but I'm just going to throw them in there. Google, yeah, they were there. Google and Amazon almost didn't make it. Amazon was a bookstore then. They almost didn't make it. They had to restructure their entire company. Their whole business structure had to restructure to include products. That's how they survived, because they almost didn't get the loan, right, to be able to continue. And then Bill Gates' company, which I don't remember, Facebook took it over, but I can't remember the name of it. It was another company, right, that Microsoft ran, and I can't remember the name of that company. But there were massive companies that fell at that time during the dot-com crash, and that was due not to the fact that they were not viable. It was due to the fact that Alan Greenspan truly did not understand the new economy that was coming into being, due to the influx of the way that you were able to buy on the internet, and that other nations could buy in the US without import and export tax. And also not understanding the online, or the what would you call that? Not so much the services, but more so where you can utilize services online, right? For instance, you could buy something that now is actually an online product, right? Virtual sales, right, of virtual products. And so that increased the amount of cash flow that was moving and so forth. And if you were using old term economic indicators, right, then you would be stuck you would say, well, I have to increase the interest rates. And so there was a big debate at that time in the 2000s. But that's an example of that, right? That is an example of that scenario. So deposits for the First National City Bank. So yeah, so that was that scenario, right? And so those banks survived. And now they were the ones that get the boom. So Amazon is booming, right? Why? Because when the internet started, it jumped into that market. It got as much money as it could. It went to all the investors. It gathered as much money as it could. It built. So when everybody got knocked off, right, they took over all the competition. Google, all of them. That's what they did. Yahoo, all of them. These are now household names. They weren't household names at that time. Like I said, Amazon they almost went under. They were one step from going under. Right? So I want you to get that if you can survive that process, if you can understand deregulated or unregulated, you want to jump in it, right? 1% market share is not, the market's not saturated, you want to jump in it, right? These are the type of markets that you want to deal with. You understand? There's other indicators and words that you want to do, and you want to make sure that you write a business marketing plan and you study the market. I like to study markets before I jump into a market. So you study the market, but once you understand and study the market, right, these are the type of industries you want to jump into, because now we're seeing the history of what happens when you do it. And I can show you this over and over and over again in many different industries. Digital camera, I can talk about that. I mean, we can go into any industry you want to. That's why Kodak went out of business, because they did not get into the digital camera quick enough. They thought that everybody would still be using the other cameras. No. When that new market comes in, you got to jump into it. And your company has to stay abreast with all new emerging markets that are in its field, in its industry. It's very important. Right? So in 1890, there are 2,250 state banks and 3,484 national banks. In 1892, there are 3,733 state banks and 3,759 national banks. 1895, deposits for First National City Bank, right, reached 3.1 million, a 158% increase from 12 million in 1893. I apologize, I repeated those, but that's where we left off. Now, 1896, The Dow Jones Industrial Average becomes a universal yardstick by which investors judge the stock market's performance, right? Dow Jones. That would be something I would study. Anytime now they took over, right? This is a takeover. What does that mean? It's become the household name. There were other measuring sticks, but it took over, right? The Dow Jones Industrial Average. That's what you hear every day. Till this day, from 1896 till today, what do you hear? The Dow Jones Industrial Average. The Dow Jones Industrial Average. The Dow Jones Industrial Average, right? Now, 1896, the Dow Jones Industrial Average becomes a universal yardstick by which investors judge the stock market's performance. 11,500 commercial banks operate in the United States. 1898, the Spanish-American War begins. The U.S. gains control of the former colonies of Spain in the Caribbean and Pacific. Much of the Caribbean's economy is already in the U.S. hands, and most of its trade is with the U.S. The war increases the business and earnings of American railroads, increases the output of American factories, and stimulates industry and e-commerce, right? Now we're moving forward. Now we're in the 1900s, right? So let's move through them. Early 1900s. Entrepreneurs want to expand and buy other companies, creating new lending opportunities for New York bankers. The most powerful and wealthy of these entrepreneurs are called robber barons, right? So now entrepreneurs want to buy other companies, creating new lending opportunities for New York bankers, right? The wealthy of these entrepreneurs were called robber barons. Interstate banking and branching is restricted. This is referred to as unit banking, right? So you couldn't do interstate banking and branching, but some states begin to allow branching at a state level, meaning you can go from city to city, but you couldn't go from state to state. So this would be like bank franchising, right? Now, 1900, checks become a more common means of payment. Ownership of capital stock increases as common people become more affluent, right? So now ownership of capital stock increases as common people become more affluent. Have surplus capital. Remember, I want you to remember that word, surplus. The other word I forgot to mention, I dealt with investing, but the other word I want you to really keep in your head is net profit. Gross profit, net profit, investing, surplus, right? Have surplus capital and have access to the stock market. Surplus capital in this sense is almost like discretionary income to a degree, and have access to stock market, right? The Gold Standard Act of 1900. This act stabilizes the economy, establishes gold as the only standard for redeeming, paper money, and prohibits the exchange of silver for gold. So now gold is the only standard for redeeming paper money and prohibits the exchange of silver for gold. Now remember, when we were studying currency, you had the silver dollar, remember? And you had the gold-backed dollars. Now it's saying you can only have gold, right? It's all dealing with banking. Now, what do we see over here on the right-hand side? The Panic of 1901. They needed to do what? Establish a panic. That means what's coming? A change or regulation, correct? Regulation. Now, First National Citibank, led by James Stillman and William Rockefeller, with Standard Oil money, buys $115 million of North Pacific Railroad stock and triggers a stock market panic. Thousands of small investors are wiped out. So First National Citibank, led by Jim Stillman and William Rockefeller, I want you to remember this word, Rockefeller, always, with Standard Oil money, buys $115 million of North Pacific Railroad stock and triggers a stock market panic. Thousands of small investors are wiped out, right? Now, because of the panic, right? Theodore Roosevelt becomes president, continues former President William McKinley's trust busting efforts, right? Because they're coming after what? Standard Oil money. Trust. Standard Oil Trust Bank. John Pierpont Morgan creates U.S. Steel, the first billion-dollar corporation, right? U.S. Steel is a giant integrated steel trust, right? And I want you to go back. If you didn't see part 6 of Rich Dad Poor Dad that I did, I want you to watch that, right? Because it talks about how these guys ended up at the end, though. Now, I want you to see how much money they got, but I want you to see how much they ended up with. We're talking about steel here, right? Morgan, right? So I want you to get this. JP Morgan and US Steel, right? JP Morgan and with somebody else. I want to say Carnegie, but I could be wrong there. Capitalized with 1.4 billion at a time when the capitalization of all American manufacturing is $9 billion. US Steel elevates both Wall Street and US industry to a new plateau. When it comes time for JP Morgan to sell US Steel, approximately 300 underwriters dispose of the securities. Really? All right. Now, 1902, President Theodore Roosevelt announces an antitrust suit against JP Morgan's Railroad Holding Company. Remember, I told you it's two gangs, right? Going after each other. But I'm going to tell you the truth. Believe it or not, in one reality, these guys won that war. Whereas Capone and them lost the war. Not the Morgans and them kind of won the war. Not really Morgan, but the Rockefellers and them. Because the government now does what the capitalists want, basically, for the most part. They can be bought, right? Through lobbying. That's what lobbying is about, buying a politician. Lobbying, the definition for lobbying should literally be buying a politician or politicians, right? Which should be outlawed, but it's not. So in 1904, the Bank of Italy is chartered in California. In 1927, the bank is renamed Bank of America of California. So the Bank of Italy, right, is the Bank of America. 1904. 1905, there are 9,000 state banks and 5,000 national banks. Notice how the state banks are growing. Remember, they were less. They're probably about a third of the national banks when the first regulations were brought in, the Bank Act, right? The Currency and Bank Act. But now the state banks are picking up, and there's only 5,664 national banks. But what's the regulation? You can't do interstate, right, with the state banks. That was the regulation. 1906, the stock market experiences a speculative boom. Now we're at 1906. The early 1900s, between 1907 and 1917, 8 states adopted an insurance plan for bank obligations. The term robber baron was revived in the 19th century in U.S. as a pejorative term describing businessmen who allegedly use unscrupulous tactics in their business operations and on the stock market to amass huge personal fortunes. Many of their massive businesses controlled a large majority of all activity in the respective industry, often arrived at through predatory pricing schemes that are now illegal. And they got rid of what's called monopolies. So that's basically what they're talking about there. Through those schemes, pricing schemes and monopolies, right? They did that. So you can't have a monopoly anymore, and the pricing schemes that they use, you can't do anymore. Some of the most notable robber barons were J.P. Morgan, John D. Rockefeller, and Andrew Carnegie, right? Now, the Panic of 1907. Boom. That means something else needs to be implemented, right? The panic is brief but significant in its financial implications. In the third month of 1907, the New York Stock Exchange goes into a drastic decline, right? The subsequent public panic leads to runs on banks. These runs lead to large-scale liquidations of call loans or loans used to finance stock market purchases. Now, a call and a put, if you understand that, we're talking about options, and they're going to deal with that a little bit later. They might deal with it in this portion, but they're going to deal with it a little bit later, I believe. And so I'm not going to talk about it right now. But right now, I just want you to understand the panic is because people are leveraging their money, or really the banks are leveraging other people's money in option loans, right? Or an option stock. These runs lead to large-scale liquidations of call loans or loans used to finance stock market purchases. As a result, thousands of businesses fail. The panic exposes weaknesses in the financial system, particularly the inability of banks to acquire currency during emergencies, right? So they weren't able to acquire currency during emergencies because they got their money tied up in the stock market. They're making money off these people's money, right? Which they do today, to this day. Our question is, why don't you do that with your money, right? So it's time for station identification. All right, everyone, we are back. Okay, great. We are good. Okay, so welcome, everyone. We are back. I appreciate everyone being here. Again, we are dealing with workshop 3. I apologize. Become your own bank. We've already went through workshop 1, understanding money, and 2, how to legally avoid taxes. We've done that. This is going to be a 2-part. Become your own bank. I'll be doing it again either tomorrow night or Sunday. You're welcome to join. Anyone is welcome to join. If you're listening to the replay, feel free to listen to these like podcasts if you want to in the background. If you want the whole playlist, go to our YouTube channel, Let's Talk Credit. And then when you go to Let's Talk Credit, click on the live portion and you'll be able to go through these as well. You can listen to them in the background. They'll play over and over and over again. I'm going to be putting a playlist together for this. I've already got a playlist put together for Rich Dad, Poor Dad. You can be listening to that as we discuss Rich Dad, Poor Dad and understanding money and understanding how to utilize money so we can be wealthy in 2024 of the year. So this year we're going to be learning a lot and we're going to be implementing so that next year we can begin to see our wealth increase and grow. Okay. So with that, we're going to come back to where we left off, the panic of 1907. The panic is brief but significant in its financial implications. In the third month of 1907, the New York Stock Exchange goes into drastic decline. The subsequent public panic leads to runs on banks. These runs lead to large-scale liquidations of call loans or loans used to finance stock market purchases. As a result, thousands of businesses fail, right? Thousands of businesses. But this is an economic boom. That was an economic boom time for the entrepreneur. If you saw that, it brought up the point about entrepreneurs. So you saw business booming at that time, right? So the panic exposes weaknesses in the financial system, particularly the inability of banks to acquire currency during emergencies. Depositors run on the Knickerbocker Bank. J.P. Morgan and James Stillman of the First National City Bank act as a central bank, providing liquidity to the Knickerbocker Bank. Their efforts stop the run. So now the banks, instead of going to be bailed out by the government, went to the what? Corporations in order to be bailed out. They actually went to the city bank, the bank. But this was another bank bailing out a smaller bank, right? President Theodore Roosevelt provides Morgan with $25 million in government funds, right, to use to control the panic. So now they were able to vie for Morgan. This now is a bank bailout, right? Just like we saw in 2008. Look at that, 1907 or 1907, 1908, right? 2008. Start paying attention. Really start watching how all of this flows together. That which has been is now, and there's no new thing under the sun. If you can see the past, you'll be able to see the future. So that is very important to get these concepts, right? Their efforts stopped the run. President Theodore Roosevelt provides Morgan with $25 million in government funds to use to control the panic. Morgan, acting as a one-man central bank, decides which firms will fall or which ones will fail and which firms will survive. Now, look at the power that was put into his hands. No different than the power that was just done in the bank bailout in 2008, except the government had the power. So the difference is, what I'm saying is, they put all that power in Morgan's hands, right? Now they're determining who's going to succeed and who's not. So now what would they do? You don't know how many banks that they're actually vested in, that they might have kept those banks alive and let the other ones fail, right? Decide which firms fall and which ones will survive. He organizes a rescue of banks and trusts, averting a shutdown of the New York Stock Exchange, and engineers a financial bailout of New York City. Morgan is a strong adherent of a central bank like the Bank of England, which is controlled by private bankers. European bankers who had lent money to the U.S. back away from that role. So he's handling that now, right? Now, let me do this real quick. Hold 1 second for me. I need to drop this so I can see now. Hold 1 second. I'm hoping I'm not doubling back through. Hold 1 second for me. You know what? I need to come out of that. Man, that would be messed up if I'm doubling back through. Hold 1 second. I want to be here. And let me see here. No. No. I do apologize. I need to do something. It's not letting me do it. Why? I'm here. But I want to be here. No. Give me 1 second, guys. I do apologize. I don't know why it's not allowing me to do what I want to do. Oh, maybe because no, that's correct. Yeah, that's correct. I want you. Okay, there we go. Sorry about that. Let's go here. I want to get rid of that. Okay, so let's continue. So President William Taft begins trust-busting proceedings, carrying on with the intent of President William McKinley and Theodore Roosevelt. Taft establishes the National Monetary Commission. The commission's goal is to propose a banking reform platform. None of the commission's proposals make it to the floor of Congress. The report is comprehensive. Congress takes years to study its proposals for a central bank and other banking issues. Moody's Investors Service provides its first credit rating on railroad bonds. In 1910, Sears and Roebuck offers lines of credit, right? So now Sears and Roebuck is offering lines of credit. 1911, the Supreme Court rules that Standard Oil, which has 64% market share, notice, see how I was saying you want to jump in when it's 1%? Now they have 64% market share, is a monopoly, and orders it to be broken up, resulting in the creation of 37 new companies. So 37 companies were made out of this because they became a monopoly, because they own 64% of the market. They got scared, they got too big, right? Congressman Arsene Pujol, chairman of the House Committee on Banking and Currency, investigates the influence of money trusts. Remember this word, trusts. Remember that was Standard Oil Trust Bank. The influence of money trusts over U.S. finance and commerce. The hearings reveal the scope of control exerted by J.P. Morgan. See how they use J.P. Morgan? But Standard didn't jump into that game, but they used J.P. Morgan. But now they're coming after him. The hearings reveal the scope of control exerted by J.P. Morgan and First National Bank, Citibank, with 341 directorships on 112 companies. These companies control $22 billion in resources. I want y'all to pay attention. of the war going on for real. 25,000 commercial banks are operating in the U.S. Right? I want you to get that. Now, the Federal Reserve Act of 1913. This is what we live under now, right? This act passes in an attempt to bring stability to financial markets after the panic of 1907 exposes weaknesses in the uncontrolled system. In other words, the unregulated system, right? That was the breeding ground. Now they're going to try to control it, or what the term that is used normally is regulated. This act, the Federal Reserve Act, so the 1907 panic, the reason they promoted the panic was to create this. Okay, so be clear. This act passes in an attempt to bring stability to financial markets after the panic of 1907 exposes weaknesses in an uncontrolled system. This act establishes the Federal Reserve System, commonly known as the Fed, as the central bank, the nation's third central bank. The bank has a 20-year charter. The McFadden Act of 1927 gives the FRB permanence, gives the Fed. So now the McFadden Act in 1927, right, gives the FRB permanence. It gives it, that means, in other words, not 20-year charter, permanence. Gives the Fed authority to regulate and supervise state member banks, right? Allows state member banks and national banks to borrow money from the FRB when they're experiencing liquidity problems. Allows national banks to open branches where? Overseas. Moderately expands national banking powers by permitting real estate loans, time and savings deposits, trust services, and foreign branches, right? And I want you to understand that the federal banking system, the Federal Reserve System, is not a government entity. It is privately owned. So I want you guys to be clear on that. And I want to say it's Rockefellers that own it, but I am not too clear on that one. I got to make sure of that 150% before I make the statement. Now, 1913, Congressman Carter Glass sponsors legislation to create a central bank, right? World War I, 1914 through 1918. Just like taxes, remember, we talked about this yesterday. World War I is a major stimulus to the U.S. economy. Why? Because of taxes. We talked about that Wednesday, right? In the historical treatise on taxes that we did, we talked about that on Wednesday. The economy booms between 1914 and 1918. The financial havoc reigning in Europe presents U.S. banks with new demands for services. The U.S. economy is the largest in the world. It's the largest in the world, the U.S. economy, right, at that time. Okay? Now, the next thing that I want us to talk about is, no, we're going to continue. The financial havoc reigning in Europe presents U.S. banks with new demands for services. The U.S. economy is the largest in the world in terms of gross national product. The financial center of the world shifts from London to Wall Street. America has now become what? The superpower. Follow the money. Follow the money. After the war, the economy flourishes. Here it became the superpower, but it's not going to show up until later. But it became the superpower right at this moment. 1915, there are 18,227 state banks and 7,598 national banks. First National City Bank, or Citibank, has $1 billion in assets. Owned by who? JP Morgan, right? The Roaring 20s, right? So we're in the 1920s now. With their newfound people buying record numbers, everything from houses to cars, appliances, assembly lines increase production, department stores give credit cards to wealthier customers, and metal charge plates are introduced. Oil companies offer courtesy cards for charging gas. Banks offer installment loans, mortgages, and loans to stock market speculators on 90% margins. That is crazy. 90% margin. There are no insider trading laws. The dramatic expansion in the financial sector introduces new corporate securities issues, especially in common and preferred stock. The stock market undergoes an extraordinary, unprecedented expansion and is caught in speculative euphoria between 1925 and 1929. Uh-oh. What do we see in 1929? Here we go. About 10% of U.S. households own stock. Today, about 50% own stock, largely because of 401ks, right? 401ks, and that makes sense. That makes sense. We talked about that. As a matter of fact, we're going to talk about that for real here. We talked about it in Understanding Money a little bit, but we're going to talk about that within this project, I believe. We're more than likely going to go deeper into those. But I think we went pretty deep in Understanding Money, but we can go deeper. Why wealthy Americans look for ways and means to invest their surplus funds. The middle class considers retail brokerage houses and security affiliates of commercial banks safe investments. Banks unveil new security affiliates with names almost identical to their own to wipe away the distinction between saving and speculating. So banks unveil new security affiliates with names almost identical to their own, right? To wipe away the distinction between saving and speculating. First National City Bank and its stock subsidiary, the National City Company, have 2,000 brokers selling stocks. National City Company repackages bad Latin American loans from its affiliated bank and sells them to unknowing investors as new securities. So they're taking bad bank loans, wrapping them up, and then selling them as securities, as stocks, basically. This is one of the deals that initiate the Glass-Steagall Act of 1933, right? So this ain't no different than what they did with housing in 2000, from the late 1990s, 2000s into going into the 2008 housing crash, right? So the housing market crash was due to something like this, but they were just doing it on bad loans with the banks. So this is what caused the 1930 stock market crash, right? So we're looking for those type indicators this round, right? Banks speculate on land development. The financial environment of the Roaring Twenties creates new financial products. First National City Bank create instruments that include the unit trust, known today as the mutual fund, right? So they created the mutual fund and compound interest savings accounts, right? And these are the regular savings accounts with compound interest. The McFadden Act of 1927. This act establishes the Federal Reserve Board, the FRB, as a permanent central bank, right? Prohibits interstate banking. This prohibition is not repealed until 1994. So from 1927 to 1994, there could not be interstate banking, right? Authorizes hometown branches for national banks if allowed by the state. This authorization helps to put national banks on par with state banks. National banks still cannot branch outside of the city in which they are headquartered. Gives national banks the authority to buy and sell marketable debt obligations. So next is 1929. 1929, there are 17,583 state banks and 8,150 national banks. Now, this is a very important time. And we're going to talk about what they call Black Tuesday or the stock market crash of 1929, right? This happened in October 29th, 1929. The crash of the U.S. stock market heralds the beginning of the Great Depression. The Federal Reserve keeps money tight. The Dow drops 25% in 2 days and 30% in 1 week. Public confidence in government and business plummets. President Herbert Hoover tells Congress the worst effects of the crash are over. That was not true, though. The worst effects on the market, maybe, but what took place after that was, for years, was very rough. So in 1921, the Dow begins its post-war boom. In 1922, the Dow tops for the first time, closing at 100. In 1922 to 29, the Dow rises 400%. In 1929, the Dow hits its pre-crash high, closing at 381. In 1921, Black Thursday, the crash begins. A record breaking 13 million shares are traded, indicating panic. That afternoon, 5 banks pony up and 20 million each to buy stock and restore confidence. Now, I want you to remember yesterday in taxes what was being built at this time, right? On our when we went through taxes, it was the one of the largest tax buildings was being built right at this time in 1930 when the crash took place, right? $6 million they spent on that building, right? I think it's the IRS building, but it might not be. It might have been another tax building at this time. But yes, they're building a brand new building at this time when everybody else, when all this is going on, right? So this was induced. That's why I told you money and stock are what? The value is based on people's imagination. So if the people are frightened and afraid, right, the rest will be frightened and afraid. Okay, so it's very important to understand that concept. Very important to grasp and understand that concept. Now, let's continue. The Dow drops another 30 points, nearly 12% to close at 230 on trading of 6 million. Okay, we got that. Oh, that was Black. I'm sorry, I didn't finish Black Thursday. That afternoon, 5 banks pony up 20 million each to buy stock and restore confidence in the market. They were hustling to get the what? People's imagination believing that the stock market was sturdy. It seems to work. There's a late rally and the Dow closes at 299. October 25th, 1929, the rally continues and the Dow closed at 301. October 28th, Black Monday, the rally ends, panic selling resumes. The Dow drops almost 40 points, nearly 13%, and closed at $260, right? Black Tuesday, the Dow drops another 30 points to close at 230 on trading of 16 million shares. The Dow closed at July 8th, 1932. The Dow closes at 41.22, an 89% drop from its pre-crash high. 1954, 25 years after the crash, the Dow reaches its pre-crash high again, closing at 382. So it took from 1932 to 1954 for it to really rally back up again to its full potential, right? Or to the highest potential it had up until that time. Now, the 1930s, the Great Depression. And this is a deep time right here as well, right? This time is a very deep time, okay? Hold on a second. So this is a deep time also. This is the Great Depression. So we're going to end here and we're going to pick up. I might have to have a part 3 to this, but it's worth it. We need to have it. So we'll pick up this tomorrow night, right? Probably around 9 o'clock p.m. We will pick up where we left off and we will continue with a part 2 of becoming your own bank, because we have to understand these ups and downs, the ebbs and flows, so you can understand why you don't want your money in this. You do not want your money in this, number one. And number two, if you're going to have it in this, understand the economic indicators to let you know when to move and what to do. All right. And I advise, as always, to have experts handle this for you, or have someone that's advising you also. All right. So welcome those that are on the Zoom. On the live. We were in the middle of, again, dealing with becoming your own bank. We're going to be doing part 2 tomorrow night. We did part 1. You'll be able to watch the restream of this. We're also going to we also have already done part 1, understanding money workshop. That should also be in the playlist on the on whatever platform you're on, but the easiest way is to go into the live on YouTube as well. And then also we have Legally Avoid Taxes, and we did that workshop as well. This workshop looks like it might have 2 or 3 parts. Becoming Your Own Bank, this was part 1. This is giving you the first step of the historical treatise. We'll be doing the second step of the historical treatise tomorrow night, and then we will move into the third part of Becoming Your Own Bank Sunday as well. Also on Sunday late night, 9:30 p.m. Central Time, 10:30 p.m. Eastern Time, we are going to be having a program called Understanding Money. And then Sunday as well, we're going to have at 7:30 p.m. a sneak peek into our services, what we do, how we help you. You will be able to be a part of that as well. So we have a big day Sunday, 3 major events on Sunday. And I'm looking forward to seeing you all there. So with that, with no further ado, we're going to go ahead and close out station identification. And I love you all with a perfect love, and there's nothing you can do about it. Have a great evening. Peace.